Hi, everybody. My name is Kat Del Grosso. I work at College Ave, and I am going to give an overview tonight, or maybe the afternoon for you, depending on where you are. Um, I'm going to give an overview of federal and private student loans that will help you in pharmacy school. Um, it is good for you to be prepared ahead of time to understand kind of what's available to you from a loan standpoint, and because a lot of you will end up needing student loans to help get you through. So I'm going to try to, kind of give you the lay of the land. And you may or may not have borrowed in the past, which is totally fine. You may have borrowed one or both of these types of loans that I'm going to concentrate on tonight. You may not have borrowed before at all. So I'll try to, cover all audience members tonight. I know that many of you tonight are prospective students who are looking um, at going to pharmacy school. There are also a large number of you who are current students. So we also have some advisors and some parents on the line and some other folks as well, from AACP, et cetera. So I'll try to make sure to cover it so that everyone feels like they're gaining some knowledge for tonight, going forward. So, first of all, it's important for us to kind of go over this slide for quite a few minutes, only just to compare for you what the difference is between federal loans and private student loans. So, they're both considered student loans. Both types are considered quote unquote student or educational loans, but there are definitely some differences in the dollar amounts, the interest rates, where the money comes from, and all that stuff. So I'm going to kind of go back and forth, left to right on this slide, just so you're aware of what's there, and all the facts behind it. So the federal loans, the money is actually coming from directly from the federal government. The programs, the federal loan programs are administered by the Department of Education. So that is a federal entity. So they are the ones who are administering the program, dispersing the money, otherwise known as, sending the money out to the schools, that type of thing. Whereas on the private loan side, that money is actually coming directly from banks or credit unions or private lenders, like where I work, at College Ave. And so the thing to know, though, is that there are federal laws that we have to adhere to on the lender side to make sure that you're protected from a borrower standpoint. So just know that even though you may need a private loan, you may need a federal loan, you may need both of them. There are federal laws that are backing you, if you will, so that you know that you're protected. There's a lot of transparency that goes on behind the scenes. And so I like for people to know that and feel comfortable knowing that it's not just, the wild, wild west. There's a lot of laws that happen behind the scenes, and we try to make sure we do things right. So how do you apply? The federal loans, you have to fill out the FAFSA application. And what that is it stands for Free Application for Federal Student Aid. So there's no fee to apply. You have to fill it out if you want any kind of federal direct loan, whether it's a federal direct student loan or a federal direct grad plus loan. I'm going to talk about that here in a minute, and the different types. On the private loan side, you don't have to fill out the FAFSA in order to apply, whereas you're actually applying directly through one of the banks or the credit unions or the private lenders. So a lot of times I'm going to show you tonight, like or talk about it a little bit tonight, but you actually typically you go through the college or the university to find out, okay, what do they recommend for the process in terms of applying? They may have some recommended private loan lenders for you that they have vetted. And so I would follow the process to apply through them, through the school, to get to those banks, credit unions, and private lenders. So, but the FAFSA is not required for those. The application really is directly through the lenders. The interest rates. So the interest rates for federal loans are fixed for 1 year at a time. So they're set They start July 1st, they go through June 30th of the next year. So right now we're working on the July 1st, 2026 to June 30th, 2027 interest rate. And at the bottom of the screen, you can see what the interest rates are for the graduate level student, which you'll be as a pharmacy student. Unless you're starting kind of as an undergrad student, you're in like a 6-year program type of thing. My interest rates that I've listed here on the bottom are really more about the graduate side of it. Um, so the 8.07, this current year is the federal direct unsubsidized loan interest rate, and then 9.07 is the interest rate for the federal grad plus loan. So, those rates are set every year. And so the year that follows this one, so it'll be the 27-28 academic year, that will be a different fixed interest rate because you apply every year for this stuff. So that's it kind of on the federal side. Once a year, the rates get set and that's good for that year. And then the next year, it'll be a different interest rate. For the private loans, however, it's more like it's a loan based on whatever the rate is. You're applying based on whatever the rates are that day. So if you go to apply now, you're offered a fixed and a variable interest rate, you can choose between fixed or variable. The lenders typically will either offer one or both of those options, and you can choose what you prefer, and it's based on, so if you chose a fixed interest rate on a private loan, it's fixed for the duration of the loan. If you pick a variable interest rate, that rate can fluctuate all throughout the life of the loan. So just know that going in. But either way you slice it, fixed means fixed. So it's good for the life of the loan. But the other thing to make sure that I say a second time, is you do have to apply every year for these things. So it's not like you can't typically apply and then just never need to apply again. It's not like a home equity line of credit, where you would be taking on, one loan to last you throughout college. You do have to, sort of pay attention to the deadlines for financial aid each year so that you're applying and getting ready for the next academic year there. Okay, so that's how the interest rates go. And then the next line down is regarding origination and application fees. So on the private loan, well, I'll start with the federal loans. The federal loans do not, unfortunately, they do have an origination fee. An application fee is kind of the same, it's all semantics. The wording is similar. It's an upfront fee that gets deducted from what you're borrowing, and then you net the rest. So let me give you an example. So if you borrow a $10,000 loan and the origination fee on, in this case, the federal direct unsubsidized loan is 1.057%. So the federal government is going to keep 1.057% of $10,000, and you're going to net 9,800 and change at whatever college you're attending. So unfortunately, there is a kind of a fee that goes up front with any of the federal loan programs. It's kind of been that way. I've been in this business for quite a while. I've worked in the field. To be honest with you, this is my 32nd year in this field. So this fees have been sort of a thing with federal loans for as long as I can remember. On the private loan side, there typically are no origination fees. So if you apply for a $10,000 loan, you would typically net a $10,000, amount at the school. There are some examples but to be honest with you, there are so many lenders that offer a 0% fee, like no fee, that you can definitely find one without a fee. Because there's so few that would even charge a fee. So that's the private loan side there. All right, moving on to how the money comes to you. So the funds are actually dispersed directly to the college or university directly. So the money will arrive at the school, and it will come in typically even disbursements. Let's say you're going to a school that uses a fall, spring semester kind of setup. You'll get half of that loan would be dispersed in the fall, half of it in the spring. And what they do is the school will cover their tuition and fees first, and then anything that's charged directly by the school, and then you would receive the excess loan amounts to help you towards your living expenses, like your rent and your groceries and books and living expenses and transportation, things like that. So that's how that works on the federal loan side. And as luck would have it, that's how it works on the private loan side as well. So there's no distinction really. It's typically should be similar on both sides. So the money comes directly to the school in both cases. All right, so how much can you borrow? So the loan maximums for federal loans I have on the next slide. I'm going to kind of show you the dollar amounts. Most of the federal loan maximums do not cover the total cost of attendance, unless you're going to a very, not so expensive school. Most of the time, students are not able to cover it fully with a federal loan. I will give you a nuance on that in a moment if you're a current student. But just know that you may have to mix up a few things in terms of how to cover your cost between, income from your family, assets from your family, federal loans, and maybe some private loans mixed in there. So that's sort of the purpose of tonight, is so that you're educated on what's out there and you'll know and you won't be surprised at the last minute. Okay, moving over to the right, how much can you borrow there? Typically, you can borrow up to the cost of attendance minus any, pardon me, any other financial aid that you have, so you're basically able to borrow up to the cost minus other financial aid. In most cases, that's what lenders, they let you borrow up to the cost minus aid. And other financial aid may be like your federal loans. So in other words, your federal loans plus your private loans, plus maybe you got a grant or a scholarship, or maybe some federal work study or something like that. All of that has to kind of fit within your cost of attendance. So you can't exceed that, but basically the private loans can kind of help you get up to that top number so that you can be able to afford all of the different things that go into the cost of attendance at school. Okay, last two bullets on the left, the Grad Plus Loan Program. So this is the federal Plus Loan Program was eliminated for new borrowers. So since I have a large number, actually about half of our crowd tonight are prospective students who are not yet in the pharmacy program. Just know that you will, if you're new, you've never borrowed in your pharmacy program before, or this is, by the way, this is a graduate thing. This is regardless of what graduate or professional program you're choosing. The One Big Beautiful Bill Act that was passed last July of 2025 changed the law, and unfortunately it eliminated this federal Graduate Plus program, which was allowing students to borrow up to the cost of attendance minus financial aid. So essentially, it was eliminated July 1st. It was over. The only people that can use it are those of you who are current students who are, you've already borrowed before July 1st of 2026. You can still use it. You're actually considered a legacy student for up to 3 years, or whenever you hit your degree, whichever comes first. So if your time to, your pharmacy credential is 2 years from now, then you can have those 2 years. If your time to credential is, greater than 3 years, basically the max is 3 years. So again, you can only use the federal Graduate Plus Loan Program if you are a legacy borrower. It's someone who had borrowed federal loans previously. It could be any kind of federal loan that you borrowed before, but it had to be before July 1 of 2026 in your graduate professional program. So again, that was the law that changed. That is a very big deal because unfortunately, at the time, prior to that, students had access to be able to cover up to the cost of attendance, and now they don't. So that's where private loans may come in, where you need some help and getting yourself up to that cost of attendance and being able to afford it. So, sorry for that bad news. I know many of you probably have already heard of this news, and if you haven't, it's good to be aware of this right now, because, the law has kicked in already. Um, Also, co-signers. So if for private loans, you can either apply on your own with your in pharmacy school, or you can apply with a co-signer. A co-signer is basically someone who is a co-borrower. You're a borrower and they're a borrower. And essentially you both kind of have responsibility if the student isn't paying back the loan, the co-borrower, the co-signer can help and, to make sure that the payments are made on time. A lot of the private loan lenders, the banks, the credit unions have like a co-signer release program where even if a co-signer is on the application, eventually you could try to, just request to remove that person as move along during your repayment. So it's not always a forever commitment. It's just kind of helps you get reduced interest rates and it can help you get approved. Private loans are credit based, so they are, whereas the federal Graduate Plus loan and the federal direct unsubsidized loan for pharmacy students, they are not they don't really look at credit as much, basically, if at all. So the private loans do look at credit and make sure that you have a good credit to get approved. So, all right. And there are loans available for people who are looking to borrow on your behalf, but they don't want you to have to take out a loan. It could be a parent or a grandparent, an aunt or an uncle or spouse, somebody who wants to just borrow on your behalf. There are some loans available on the private loan side for that. And even if they wanted to help with, $5,000 or $10,000, there are, parent or sponsor loans available out there on the private loan side as well. All right, that was a long slide only because there's so much to it, but that's supposed to give you a good ground, some groundwork to set the stage here. Okay, so here are some things to consider. This is basically a glossary, quick and easy. And honestly, this really pertains to federal and private loans. And I just want to tell you what the differences are as you're moving in to kind of quote unquote shopping around and understanding what it is what kind of loan you might need or not so much need, but what kind of loan you want to choose, if you will. So the first one is repayment terms. That basically means how long am I going to be repaying this loan? I have a repayment term of 10 years to repay it? Do I have 12 years, 15 years, 20, 25, 30? And so those are considered repayment terms. The second item on here are called repayment options. Those basically are kind of like the way you're going to pay them back, pay the lenders back or the federal government back. Such as, am I paying the whole thing back like right away, or am I deferring some of it until later on? Am I deferring all of it until after school later on? For example, a lot of people like an interest-only repayment option because they can kind of prevent interest from accruing while they're in school, but they don't want to have to pay back like the whole, kit and caboodle. With principal and interest. They can just pay interest only during school. So that's an example of an option, a repayment option. And then there's a multitude of repayment options available on both the federal and the private loan side. Third item here is borrower benefits. What does that mean? That basically means it's like a discount that you can get during repayment for, let's say, auto debit is the most common one. So if you automatically debit your checking or savings account to make your payment back to the lender or the bank, that's considered, that's one of those things where a lot of the private lenders will offer borrower benefits to give you an interest rate reduction if you decide to do that. Because to be honest with you, it's better for the lender because then they know they're going to get their money back every month as opposed to hoping they'll get their money back. If someone has to go in and physically make a payment online or on their mobile app, they don't know if they're going to get the money. Whereas if you set up auto pay, it's definitely it's an enticement to the lender to give you a discount, really. So that's considered a borrower benefit. And The federal side doesn't really have that anymore. They used to, but they don't really do that right now. But the private loan lenders do that. Prepayment penalties. So prepayment basically means that if you, let's say you go when you graduate, well, even while you're in school, you're taking out loans during school and you win the lottery or something, or grandma gives you $1,000 graduation gift and you want to put a chunk of money, any kind of chunk, something bigger than your regular payment's going to kick in. That's considered what's called prepayment. So you would be basically, I'm prepaying my $1,000, I got this extra influx of some money. I'm going to put it towards my student loan, and it's going to save you money in the end by plugging it in there early. You want to make sure that you're borrowing through lenders who don't penalize you for that because honestly, prepayment is a great thing. If you're able to pay a chunk at any given time, you will end up paying less overall. So, hands down, mathematically speaking, that is how it works. So, you want to make sure you're picking like a loan options that don't have penalties for those sorts of things. Be honest with you, there's so many lenders that don't have a penalty for it. So I just want to caution you not to. I mean, I personally wouldn't choose one that has a penalty for that. Okay, the next one is grace period. So a lot of students will ask, what about, after I graduate, how much time do I have before I have to make payments back to my loan? This is really what grace period means. The grace period is essentially the time between when you graduate or you become less than half time and when your loan kicks into repayment fully. So a lot of times, like for pharmacy school or for any students who are in like the graduate and professional side of, education, these are types of loans that give you typically like minimum of 6 months before you'd have to repay the loan. But a lot of times it's 9 or more months that you get after school. So you'll want to shop when you're shopping for what you're, going to be borrowing, you'll want to look at what's the grace period? How much time will I have after school? So it'll become important because you're going to be trying to get on your feet at that time, get your job underway, get your housing underway. Let's say, what if you're moving? You want enough time where you could pay interest if you wanted during that period, but you don't really want to have to be on the hook for the whole thing yet because you just are going to need that buffer. And then lastly, deferment and forbearance options. Here's the difference on those. So federal and private loans have deferment and forbearance options as part of the programs. They will vary by the lender. So the federal programs are, like I said, administered by the federal government. So those rules are those rules. The information, if you, Daniel, maybe you could put this in the chat for me, if you don't mind, but studentaid.gov studentaid.gov is where you can go to look at the different federal deferment and forbearance options. For the private loans, those will vary by lender, but I will tell you that deferment is pretty typically, it's very similar in a lot of the private loan lenders. You can have a deferment if you're going back to school full time, or if you're going into the military, or if you are, those are the most common ones, to be honest with you. The forbearance options, that basically means that you're suffering some kind of a hardship and you're not able to make your payments, not because you're going back to school, not because you're going necessarily just, into the military, let's say, but you're having like maybe a natural disaster has hit your area, maybe you lost a job and you need a forbearance sometime during your repayment period. So, that really is like both deferment and forbearance options are a period of time where you're already in repayment, but you need a break. So you need like a pause, a payment pause. And those are the different things. Those are the options that you have when you need that kind of break. So again, when you're shopping for the different loans, on the front end, when you're borrowing for pharmacy school, you want to make sure that the lenders or the loans that you're picking have, these things so that you're making, because when you need them, you're gonna want them. So it's good to know on the front end what they have available. Alrighty. So I Danielle was great to send a list of questions ahead of time from the audience, to, and there were a lot of questions on there. So I threw a few of them here in the slides just to see, just to capture some, some questions here. And one of them was, should I make payments while in school? So I would suggest try to make at least some payment in school if you can. You could do interest only. That is an option. It might be too much though. Like let's say you're borrowing 60,000, 80,000, $100,000. Interest that's accruing during the in-school period, um, it could be too much for you to take on to have to pay that every month. But what you could do is to, either try to pay that, or maybe if you do have a cosigner, if it's a private loan, whatever help you can get to pay the interest while you're in school, that will definitely reduce the overall cost of your loan. Again, mathematically speaking, that's how it works. Otherwise, that interest is going to accrue while you're in pharmacy school, on both federal and private loans, unfortunately. So, they're graduate level students. If you're undergraduate level, it's one thing, because there is a loan that doesn't accrue interest while you're in school. That's called the Federal Direct Subsidized Loan. But for graduate and professional students, the interest does accrue on the federal loans and then the private loans too. So anything that you could pay towards interest during school would be awesome. Um, there are some lenders that offer some kind of middle of the road repayment options as well. Like, for example, can you pay $25 during the in-school period? That may not equal your interest that you're paying, but at least it's a dent. And it's like, I always think of it as one less pizza a month. And if you can put even a little bit towards your loan, it will help you in the long run. And then signing up for auto debit can also help you. Some lenders, like where I work, you can make payments. You can basically sign up for auto debit even if no payments are due. It's still going to give you an interest rate reduction during school. So that also is a little secret side note there. So there's different ways to kind of help you have a cheaper loan in the end. So should you make payments in school, while you may not be required, see if you can at least periodically put some money down in there, even if it's just a little amount. And then another question I got in the list was, is there a way to keep track of your, on your end, basically? So here are the things that you should keep track of. These are things that are going to be disclosed to you when you're borrowing both federal loans and private loans. So keep track of what was your interest rate for that loan. That, remember I said earlier that you would have a fixed interest rate, like a fixed or a variable interest rate per loan. So each loan you're taking out has, per academic year, it's got like different stuff going on. Trust me, you will not want to deal with memorizing this later. I mean, I've worked in financial aid offices on campuses before. I've worked at I didn't say this earlier, I'm sorry, but I worked at Syracuse University. I worked at University of Rochester in Rochester, New York. I've helped students for so many years. It is a little daunting when you go to graduate and you don't have like a handle on all this stuff that you've kind of done over the course of your education. So the earlier you start keeping track of this, day one, when you go in, if you take out a loan, you're going to need some way to track these items. I'm a spreadsheet person, so for me, it's just as easy as, anything. But you can definitely, either do this by way of a spreadsheet, you can use online apps, but do something that will allow you to track your loans, the interest rate, the total loan amount. Finance charges are the amount that you're going to be, like, because of the interest rate that's charged, the loan amount that you originally borrowed plus the finance charges will equal the total amount of payments that you have due. So if you have kind of a track of how much is going to go into this in repayment, you will thank yourself later to understand, okay, where am I starting with here? Because it's just so much easy. It's so much nicer to be organized, and also maybe it'll help you not borrow as much. Because if you're doing this all throughout your degree, then you may say to yourself, oh my goodness, I already took out X amount of dollars last year, and with finance charges, I'm a little worried how much I'm going to have to repay in the end. Maybe this year I'll try to take $1,000 less or something like that. So it kind of just it's an eye opener, to be honest. So if you do it right from the beginning of while you're in school, you'll be happy, I think, to keep track. Your monthly payment amount is another item, and then the payoff date, which the payoff date is the most exciting part because that's like, okay, I have something to work towards. And you will, again, thank yourself when you've graduated that you kind of have an understanding of when the first loan is to be paid off, the next one, and it'll help you organize. That's a whole different presentation about, kind of what to do when you're exiting school, but it will help you when you're leaving school as well and graduating. Okay. Now I'm just gonna look at the chat real quick here, and I think Danielle is Danielle, I'm not sure if you're okay.
We do
Oh,
have a few questions. I don't know if you want to go through them
yeah.
now or wait till the end. Do you want to just do them now?
Let me see here. Let me toss in. Well, let me do a couple more slides just because I have to show the dollar amounts, and I want to make sure that helps people.
Okay,
Um, so let me get through those dollar amount charts, and then we'll, I think, go back to the chat.
sounds good.
Okay, so what is the best way and strategy to pay off loans was another question that came through. So again, don't overborrow. Again, my last slide, I gave the advice of maybe just don't take out that last 1,000 for 1 year. And, over the course of many years, you've just saved yourself multiple thousands of dollars, plus all the interest that would accrue. Pay at least a small amount while you're in school. Create a budget that includes your monthly student loan payments. I think people, when students graduate, it's hard because sometimes you don't think about, okay, I'm going to make X number of dollars in my pharmacy, as a pharmacist, but then the federal government and state governments take their share in their taxes. And then I've got to pay my, maybe a car payment, rent, my phone bill, my Netflix, whatever you've got to pay, but you also have to budget in your student loan payments into that budget. So if you kind of do that on the front end a little bit and teach yourself the budgeting during school, that will really help a lot when you're out of school. That one I can definitely tell you from experience. So that's definitely key. And then the auto payments I mentioned a bit ago. So it's predictable for you, it's predictable for the lender, and therefore that will sometimes translate into discounts, which is less money you have to pay back. So that's a good thing. Is it better to take out loans in smaller portions to help minimize interest? No. And I know that may sound biased because I work at a student and in private student loans, but I'm also here to give you non-biased advice tonight. That's just how I roll. So basically when you need a loan for an academic year, it is not a good idea to borrow on a semester basis, or let's say you're going to a school that has a quarter system or a trimester system, however they do it. You don't want to have to go back to the well each time to do a credit check each time, because that's going to affect your credit score for your credit reports. So you don't necessarily want to do that. The second thing is then the school also has to certify it again, which could take a little bit of extra time. And sometimes when you're applying and it's close to when your bill is due, that can cause some stress. But honestly, financially speaking, I would say apply for the whole year at the same time. And the reason is because interest doesn't even accrue on money until it's dispersed to the school. So it's not like anything is adding up. So I always tell people, just borrow for the whole year. It's peace of mind. You're not paying any extra because you are your second disbursement or your third disbursement, your fourth disbursement that's going to come to the school later. There's no interest accruing on that anyway. So what's the harm in just getting it done, having it done, peace of mind. Um, the only setback to this would be, oh my goodness, the interest rates dropped dramatically and I could have gotten a better rate. You know what? If that happens, you can always cancel your second disbursement in the spring and apply for a new loan if the interest rates really went crazy and went dipping down to low, low, low. But it's not gonna happen right anytime right now anyway. So I think you're better off doing it for the whole year. Okay, so if you are a prospective student and you still have to go into the undergraduate level of pharmacy, like before you, if you're going into undergrad first and then you're doing finishing out with your pharmacy program, in other words, you're not going right now into pharmacy school, you're still like, you might, I have a lot of you on this phone call who are prospective students. So I'm assuming some of you are kind of coming out of high school. Some of you may be in your undergraduate level wherever you are. I just want to make sure to have this available for everybody tonight. So if you have some undergraduate borrowing to do, these are the dollar amounts. This year, if you're an undergraduate student, the interest rate is 6.52% for these federal loans, and the origination fee, which I mentioned earlier, is 1.057%. That's the amount the federal government will take out ahead of time, and then you'll net the rest, basically. But the interest rate for this academic year is 6.52%, which is not too bad of an interest rate. So if you are an undergraduate student, I would probably recommend you take these. If you're a dependent student, you're going to be in that kind of that center column there, the 5,500, 6,500, etc. The right-hand column is for independent students who are older than the age of 24 or who are in military, who are considered homeless, who basically meet the federal guidelines on the FAFSA as it relates to quote unquote independent status. If you have more questions on that, you can use that website I told Danielle to put in the chat, which is studentaid.gov, and it will give you some guidance on who's considered independent and who's not. But most, students coming directly out of high school typically, are considered dependent in most cases. So, okay, so that's the undergraduate dollar amounts, and then the graduate dollar amounts are here. So oh, excuse me, I'm sorry, I forgot I had a parent slide here. There is a parent loan as well that there's a federal parent loan that is available for undergraduate level students. And the interest rate this year is 9.07%. And in some cases, you can probably get a better interest rate than that if you go through a private loan. But if, it's not going to be the case necessarily. So shopping around might help you to understand, okay, if I apply for a federal plus loan, I know this year the rate's 9.07. I'm going to apply for a dollar amount and the government's going to take 4.228%. So in the end, like how much is this costing? Also if you're comparing that to a private student loan, instead of taking out a parent one, through the federal government, in some cases you can get a better interest rate with no fee. But again, before you sign on the dotted line, you can compare the options that maybe the college recommends. Typically, that's the best advice I can give. They have a preferred lender list, and you can kind of look at that. A lot of schools have a preferred lender list or some sort of historical private loan list where you can kind of see what other students have taken out over time, or who they borrowed through over time, and they can give you some guidance at least at the schools. And then ultimately, as a consumer, you're picking kind of what's best for you price-wise maybe and benefit-wise and all that good stuff I gave you in my glossary of terms. This is a big one. The dollar amounts got reduced this year with the One Big Beautiful Bill, so you can only borrow up to $20,000 annually per dependent student for the federal plus loan for undergrads. So and the most you can take out is 65,000 throughout the duration. So that is a huge change from what we're used to in the federal parent plus loan world. So again, on the last slide here, the undergrad amounts for the federal direct loans are here, plus whatever you can get through the federal parent loan here. And then ultimately, if you need a private loan, you might do it in lieu of this one, or in addition to this one if you need it. So there's some maximums there. And then, okay, so on the federal loans for the graduate level students, because a lot of you are going to be in a Farm D program. You are as you were considered a professional student, and that affects how much in terms of how much you can borrow through the federal loan programs if you're in one of these academic programs. The One Big Beautiful Bill Act basically is limiting quote unquote professional students to this list and this list only. So Farm D is included, and that basically means that you have higher dollar amounts. So let me show you those dollar amounts right here. So for the One Big Beautiful Bill is basically for new borrowers on or after July 1st. If you're considered a professional student, you can take a $50,000 up to $50,000 annually. This is through the federal direct unsubsidized loan program. So again, I'm in the graduate space now. I talked about undergrad loans. I talked about the parent loans for undergraduate students. Now I'm talking about the grad professional student borrowers. So that's the slide we're on here. $50,000 annually for professional, so like a Farm D student, with a maximum of $200,000 over the course of your academic program. If you are in a pharmacy program, but it's not a Farm D program, therefore it doesn't fall into this list, the most you can take out is $20,500 annually and up to $100,000 total through, maybe you also, had other programs throughout time. So you can't borrow over $20,500 a year. And again, this is for the new borrowers after July 1 of 2026. For those of you who are current students, I have quite a number of you who registered for this, who borrowed before July 1st. You're considered a legacy borrower here on this slide, and you do have higher dollar amounts, and you can access that federal direct Grad Plus loan I mentioned. So, Danielle's going to send these slides out, so you'll have this for your records. But in summary, if you're a professional student, you can take out more money, even if you borrowed, even if you're a new student versus a current student. So these dollar amounts definitely are making a huge impact on what students will have available to them. All right, so I'm going to go over to the chat real quick here. Let's see here. So question, for those already borrowed grad, is the 3-year total of borrowing on or after, excuse me, is the 3-year total of borrowing, it's basically anything you're borrowing July 1, 2026 and beyond. So you have if you're a legacy student, therefore you borrowed for the first time in your academic program before July 1 of 2026. The clock starts ticking July 1 of 2026. So you have basically until you've got July 26, 27, 27, 28, and 28, 29 years. And then basically the end of it is June 30th, 2029. So you get those 3 years starting July 1 of 2026. So that was for the first question. And then for students who are pursuing things like residency and fellowship, can federal loans be deferred? So for residency and fellowship, if you have to be enrolled at least half time in order for your federal loans to be deferred. So if you're not like technically enrolled, then the answer is no, they can't be deferred. What you can do is to go to the studentaid.gov website and look under repayment. It's pretty easy to navigate that website, to be honest. Like the headings at the top are pretty easy to navigate. But look for like the repayment tab, and then you should be able to find some more details in there about that as well. But definitely studentaid.gov is your resource on anything federal loan programs, but you have to be at least half time in order to defer your federal loans after you graduate from like pharmacy school. Are federal loan grace periods usually around 6 months, or are some more? Okay. So the federal loan grace periods are usually 6 months for the federal direct loans. That would be, like the federal direct loans like I'm showing here under annual amounts, 20,500 or 50,000. So those are 6 month grace periods, and then the Grad Plus um, is a 6 month grace period, I think. And then also the private loans typically have 9 months or more. Um, so it's not going to be less than 6 months unless it is a federal, the parent loans don't have a 6 month grace period. You have to at least the parent loans, if anyone is listening and needs a federal parent loan for the undergraduate students, you don't have a grace period for that. You actually, the repayment for that actually starts during the in-school period. So FYI on the parent loans, the federal parent loans. But if any of these student loans will typically have at least 6 months grace period. If a student is denied a private loan for cost of attendance and doesn't have a cosigner, what can they do? So this is a common one where students are kind of stuck because they don't have a cosigner available. The What I would recommend is that you talk with the college or university. The financial aid office there will help guide you to provide any advice that they have about any funding from the institution themselves, or any scholarships that you can apply for. So any additional help that they can think of, basically, and that might be unique to that institution because they might have some ways that they can assist. It is very difficult because the federal Grad Plus loan program that was just eliminated was able to give access like pretty much 100% up to the cost of attendance. So this is really kind of putting students in a position where they don't have the funding. They might not have the funding available and might have to postpone school, which is a dreadful thing. So what I would recommend is you could definitely try different private loan lenders, even if you don't have a cosigner. Um, and maybe there may be one that might approve you without a cosigner. So I would also do that. Here's my advice on that, because you might be thinking, well, I don't want to have a credit check like if I apply through 4 different private loan lenders to see who's going to approve me, isn't that 4 different dings to my credit report? And the answer is, if you're within a 30-day period of shopping for a like kind of loan, like an educational loan, or let's say you're applying for a car loan or a mortgage, anything that's like itself, basically like, 4 different similar types of educational loans, they're not actually dinging your credit 4 different times. So you're safe within a 30-day period. It's, if anything, negligible. So the credit bureaus know that you are shopping for that same kind of loan. So that is another option I would give to you, Jason, as well. The interest accrues while the student's in school. The question is, how does the interest work? Is it the day you take out the loan, the interest starts accruing? And it's actually based on when the money arrives at the school. So, or well, I shouldn't say that. When the money goes out the door from the lender. So once either the federal government disperses your federal loans or the private loan lenders disperse your private loans, the interest starts once that money has dispersed. And so it's basically once it goes out the door. And that's why if you can pay anything during school, it's great, even if it's just a small amount, $20 here, $10 there. So that's advice if you can handle it. But unfortunately, I know that money can be tight, of course. But just small amounts mean something. Someone asked, what does it mean to be unsubsidized? So that the federal government has the 2 different kinds of loans. So for graduate students, unfortunately, they don't have a subsidized loan anymore. The federal direct subsidized loan is only for undergraduate students. And it basically means that the government is subsidizing the interest while you're in school, and it doesn't start accruing until after you graduate. Well, actually, after your grace period. For graduate and professional students, unfortunately, there's only the federal direct unsubsidized loan and the Grad Plus loan for those of you who are legacy borrowers. And that all of those are unsubsidized. It basically means the government is not paying the interest while you're in school. So it's accruing on you, and you can either pay it or defer it till later after you graduate. But thank you for asking that, actually, because that wasn't necessarily intuitive. Okay, I have another one here. I'm just going to go forward with some questions here. If my student is a current undergraduate with federal direct loans, does that count towards legacy? So if the student is a current undergrad, it does not count towards legacy borrowing because the way that the law defined this in the One Big Beautiful Bill is that if you borrowed a loan before July 1st, 2026, those legacy borrowers, it has to have been in the academic program, otherwise known as basically the pharmacy program. So as an undergraduate student, they're technically considered undergrad and they're not considered a graduate student yet, even though they may be in like a 6-year pharmacy program at the same school. They're not actually counting as undergrad, or, excuse me, as graduate professional yet. So I actually don't think that they qualify. Here's the thing. There is a little bit of stuff. There are some things that are getting ironed out with a lot of Q&A on this topic. So I do think this person's name is Sarah. I do think for Sarah who asked that, you may want to double check continuously with the financial aid office at your school because there's just been so many nuances of updating this information since that law passed. And it's been a lot of confusion, to be honest, for everyone in the field. So that's what I would say, Sarah, on that. How are we doing here, Danielle? With the meeting, oh, the meeting's definitely recorded. Danielle's got that one. Is there anything a school needs to be careful of when recommending a private lender? Yeah, I mean, the school has to, there's actually laws related to recommending a private loan lender. They, sometimes they won't recommend anybody at all. They might provide you with they're allowed to have a historical list of lenders. It may be like an A to Z list kind of thing, of list of lenders that students have borrowed through in the past. It may be what's called a preferred lender list, where they have actually vetted the lenders. They've done what's called a request for proposal or request for information, otherwise known as an RFI or an RFP, to vet those students and narrow it down a little bit so that you're not staring at a list of 100 lenders. And if they've done that, then they have to adhere to, the law behind it, the federal law behind it, as to the checking some boxes on, making sure that they've done it in the proper way and disclose to the student how they've come to list those lenders. So yeah, so that the school definitely has to be careful, and they do so by way of following those guidelines that are provided to them in kind of my side of life, basically. So that was Jason's question. And then legacy borrowers. Prior to July 1 of 2026, will we have access to lifetime borrowing cap? So for anyone who's a legacy borrower, therefore you borrowed before July 1 of 26 in your pharmacy program as a grad, professional student, there is no lifetime borrowing cap. So that's this slide. So there is no lifetime borrowing cap for you there. If you are borrowing after July 1, there is a lifetime borrowing cap of $257,500 for your maximum aggregate amount. So Tanisha, the answer for you is no lifetime borrowing cap for legacy students. I'm a graduate PharmD student and my school only offered me $20,500 for the year. That's because you must be a new student. Do I need to reach out to them to get it increased? I need to mention that I have gotten, oh, okay, you've gotten federal loans for your program, so you are a legacy student, if that makes a difference. Okay, so if you think that you are accidentally labeled as a new student and not a legacy student, then yes, I would check with the school for the financial aid office to see if there was a mistake made based on the start of your pharmacy level program. And if so, the annual amount would be 50,000. But again, if you were an undergraduate student, my understanding at the moment is that you're not a legacy student. You would have been considered an undergraduate. So I would start with financial aid there and see kind of based on what year you are. And that was Nicholas who had asked that one. Is there an origination fee for PharmD students? There is an origination fee for federal loans, but not most of the private lenders don't have an origination fee. If so, because the question was, is there an origination fee for PharmD students? If so, do we pay the originating fee when the money gets sent out to the school? So, Sarah, who asked that, there's an origination fee for federal loans. So, that 1.057% of your total dollar amount for the federal loan this year will be deducted from your loan amount that gets sent to the college, and you'll net the rest. So, again, on my $10,000 example I gave earlier, if you borrowed $10,000, the government keeps 1.057% of it, and you would net the, 9,800 and change. And that's how much would go to the school. Is there any penalty for deferring payments? There's no penalty for deferring payments other than the fact that the interest is accruing while you're in school. There's no penalty though. You choose the repayment plan that you want when you're applying for loans. And then whatever you've picked, there's no penalty for that. It's just that the interest does accrue while you're in school if you're not paying it. So it's not a penalty though. It's just that this is just how loans work. The graduate and professional loans, unfortunately, all kind of have interest accruing during school, unfortunately, in most cases that I know of. So. All right. Are there any good graduate loan options for students who don't have a long credit history or whose parents don't have good enough credit to co-sign? So, for those students who don't have a long credit history, again, whole different presentation that I do. But what I would recommend that you do is try to start building credit history. A credit history can actually be built in as little as like 6 months. So even if you just start by, let's say, become an authorized user on who, let's say you have a trusted adult. It sounds like your parents don't have a good enough credit to co-sign on a private loan, but is there another relative or someone that you could become an authorized user on one of their credit cards? Doesn't mean you're using their credit cards. It just means that if they have good behaviors, you get to benefit from the good behaviors and you start building a credit on that if you're an authorized user on their credit card. So again, they don't have to give you a credit card. You don't have to use the credit card. You just becoming a quote unquote authorized user is a really good way for college students to gain a credit history. And a lot of people don't know that. So that's one way to do it. And then I would also start thinking ahead about who might be is there somebody else who might be willing to co-sign? Is there a different relative? Is there a sister, an aunt, an uncle, anyone because there's a lot of co-signer release programs. So even if you applied with a cosigner, let's say my aunt helped me out and applied for me or my grandmom, there's a lot of the private lenders have cosigner release programs where you can eventually get the aunt or the uncle or the grandma off of there. So that might help as well. So it's kind of like they help you in the short term, and then a little bit down the road, you can kind of get them removed. So. Now, Danielle, I know we're at time and there's still some questions in here and some things that I didn't necessarily cover. How would you like me to proceed?
Yeah, I mean, I think if you want to finish your slides and then
Okay.
if we still have folks sticking around, we can go through the last few questions, but we'll end at Maggie's question that came in last.
Okay, sounds good. One question that I got, Danielle had passed along to me on the list that came from you guys as when you registered. I know a few of you asked if you were international students. Can you apply? What are your options? So I do want to mention that briefly. So international students can take out these federal loan programs. So this is the undergraduate one, the parent one. Um, excuse me, let me rephrase. The international students cannot take out the federal loan ones, whether it's undergraduate here, the federal parent one, the federal grad plus, but what you can take out is a private loan. So the international students are a little bit stuck, but you can take out a private educational loan at least. So It's a so you in other words, when you're an international student or you don't have a green card, you're not and therefore you're not an eligible non-citizen either. You can't fill out the FAFSA application, so therefore you can't take out a federal loan. But you could take out a private loan. So there were several questions about that on here, so I just want to make sure and say that. Um, let's see, briefly. Okay, the subsidized and unsubsidized loan approval, no credit check required. The student is the only one on the loan. So there's no cosigner. It's just the student on the application. You have to be at least half time to obtain it. And the subsidized loans, like I said earlier, only for the undergraduate students. The unsubsidized loans are for both undergrad and grad students. If you are a legacy student and you qualify for the Grad Plus loan and you want to take that out, there is a credit check on that. And these items are this is the credit check right here. You have to have no adverse credit history, which means you can't be 90 days delinquent on balances bigger than $2,085. And you can't be in collections the past couple of years, 2 years. You can't have bankruptcy or any of those items in my indented bullets there in the past 5 years, like charge-offs or wage garnishment or anything like that. There is a cosigner program on there. It's called an endorser. So if you are a grad professional student who is a legacy student and you want to try for this loan, and you're denied, you can add an endorser on there, which would be like a cosigner. So that's the Grad Plus loan. And then federal loans, if you take a leave of absence, let's say you're in your pharmacy program and you have to take a medical leave of absence or maybe a family emergency type of leave of absence. Most of the time, if you were legacy, you're going to lose the legacy provision with the One Big Beautiful Bill. Unfortunately, this is part of the law. So if you are, when you come back to school from your leave, um, you have to go with the new loan limits, the new borrower amounts that I had on my other slide. So just FYI, before you ever decide to take a leave of absence from your school, make sure that you check with the financial aid office first, in addition to other offices like, academic advising for sure. But financial aid should definitely be on your list of stops to make because there are implications to taking time away and coming back, especially with this new One Big Beautiful Bill. So, private loans can help you pay the balance. On the private lender side, we look at credit reports and scores to determine if we're basically taking a risk to lend you money and, for you to pay back. It's, you know, Unfortunately, it's not 100% approval rate like the federal loan program was. So the lenders are looking at credit reports and your history of repaying and, that type of thing. Certainly, if you have the stronger credit, is those folks are the ones who end up getting, cheaper rates and terms just because if people have established stronger credit over time that will show to a lender. This is the same, by the way, if you were to go get a car or a mortgage or anything. If you have stronger credit, you're going to get a better deal because you're already proven to the lender on paper that you already pay back pretty well. So it's a good risk for them to lend to you. And in some cases, they might be lending you, $300,000, $200,000, $300,000 or something. So they want to make sure that they are lending to students who will pay them back eventually. But you can get a better deal for sure if you have a strong credit, and also if you have a cosigner, great. If not, it's okay. But sometimes that will help you get a better deal as well. How to apply for the federal and private loans. Okay, so I know I said on the very first slide back there that you have to do the FAFSA for the federal government. For the federal loans, you have to do the private loan application if you want to go through the private loan world. Either way you slice it, follow the school's directions because they're the ones that are going to give you sound advice based on their process. Usually there's a student portal where you're logging in and you're seeing, okay, what are the things I still have to turn in? What do I still have to, accept or decline or things like that. And most importantly, they're going to give you guidance on the financial aid office is going to give you guidance on how to navigate through this very confusing topic, to be honest with you. All of this stuff is very confusing. And you're all, we're all the same. Basically, there isn't anybody who has an advantage over understanding this unless they've been through it at least one time. In my case, I've been around a while, so I'm used to all this stuff. But for you folks, if you're newer to this stuff, can be overwhelming. So financial aid is your friend. Use their portal to understand what's needed, and they will give you advice through their individual ways. And then also try to pay in well advance of or, apply well in advance of your bill being due because you don't want to be scrambling the day before your bill is due to try to get a loan in. And you don't want to be charged late fees if you are late on the bill. So that's just general advice there. I was asked to kind of talk briefly about loan consolidation and refinance, what that means. So I just want to, for those of you so once you go through pharmacy school, um, or any kind of school, basically this is how it works in this country for federal loans and private loans. The federal loan programs, you may decide that I have like four or five, six different loans from different years that I borrowed, and you can basically consolidate your federal loans together into one loan if you wanted to. You don't have to, but you can put them all together. It basically is, here's how it works. The federal government's program is they take let's say you had six different loans, federal loans. They will take all of the loans, they will average the interest rate together, and they will round up to the nearest 1/8%. And that's your new interest rate, period. So you have one new loan, but it's just an average of all your interest rates. So if you had interest rates that were all over the map, you are hurting yourself when was high interest, when you had the lower interest rates and you're squishing it together with a high interest rate. But it might be a good way to put everything together and make it organized and easy for you during repayment. It may or may not save you money, but it does give you convenience of one payment. And in some cases, it could lower your payment if you had like really high interest rates the whole time. So you'll look into that later, not now, but later on when you get out. And then there are, if you consolidate, there may be some implications to losing some borrower benefits like forgiveness options. There are some federal loan forgiveness options available for public service. And as well as teacher loan forgiveness. So those, you would just know that you could forgo those, you might forgo those benefits if you consolidate. So again, it's not a problem for you to worry about today, but you do need to know that, hey, some other day, I might want to put all this stuff together, and this is what it means. So that's the left side here, and the right side is refinancing is kind of the same as consolidation, except that it has a different word. And basically, the difference here is that private lenders will allow you to refinance federal loans and private loans together. You don't have to put them together, but you can. Basically, if you have like six loans and three of the interest rates are terrible and you someday want to refinance just those three loans, cool. You can do that. Maybe you want to put them all together because you like the convenience of the one payment, however you want to do it. But I think the most logical thing, if you ever refinanced, is to pull any of the higher interest rates. And if you get and qualify for a lower interest rate, that's really where your benefit is. But you can put together federal and private loans together, which is handy. But it's semantics. The wording is refinance. On the federal side, their program is called consolidation. The federal program does not allow you to bring private loans in, but the private loans allow you to bring federal loans over there. So that's why I put that at the top in that heading there, federal program versus federal plus private, because it's confusing. So here's how it works. Basically, you are checking boxes when you apply for a refinance loan. You're like, okay, I want this one, this one, this one included. That private loan lender then pays off those three entities and they give you a fresh loan. The refinance loan, it has nothing to do with averaging the interest rates together and rounding up like the federal program. It's a whole new loan and you're literally paying off those other lenders. And that's how that works. So this may or may not save you money, but most of the time people are refinancing because it's going to save them money. You get the one payment. You can lower your monthly payment, but also if you bring in any federal loans into the private loan refinancing loan programs, you will be foregoing any federal loan, forgiveness option benefits if you were to go into public service or teacher loan forgiveness service. So that's how that works. That's the difference between the two programs. And then lastly, I would just say before refinancing, you kind of want to pre-qualify to check your rate, see if it is going to be better for you. Figure out, well, I don't know if I want to do all six of these loans. I just want to do a couple of them that have really high interest rates. That's probably what I would do. And then, just checking, am I going to lose anything by doing this? Any borrower benefits or repayment options? Um, what does it require? Does my credit score have to be a certain thing at that lender? Do I have to have a certain income, to get approved? And then are there any tax consequences to kind of giving up a federal loan? Because, if there are any tax write-offs for federal loans at the time you graduate, you want to make sure you're not giving up something that's, you know, that you might like to have. And then fees, most of the private lenders don't have any origination fees, but at the time you graduate, I don't know what the world will be like, but that's another question to ask. And then lastly, will you lose any discounts that you've had with your original loans? And those would be like, borrower benefits that I mentioned earlier, the perks that you would have on other loans that you'd be putting together. So those are the questions I'd say for you to ask. So you can tuck this away for later and, decide if it's for you. There are calculators you can try out. We have one here if you wanted to try it out and see how it works. I've got the URL address there. And that's it. So I know we went over. Sorry about that, but I'm here if Danielle, would you like me to answer those last couple questions before Maggie's or?
Yeah, if you don't mind.
Yeah, sure. So let's see.
I think we left at Armand where
Um,
and they asked just to confirm for students entering pharmacy in 27 or later, the maximum they borrow for federal loans is $50,000.
okay, so if you're entering pharmacy in 2027 or later, then you are not considered a legacy student. So you would have, unfortunately, you would fall into, oh no, I'm sorry. Yes, I'm sorry. Armand, I'm so sorry. I was thinking legacy. So, but yes, it's 50,000 if you're in a Farm D program if you start in 2027. So I went back to the slide that pertains to that. So if you're in Farm D, you're good on the second row. If you're not in a Farm D, but you're in a pharmacy related adjacent program, there could be others of you on this call that aren't doing Farm D per se, but you want to do something else related, you'll fall into that graduate student line. But Farm D will fall into the second line where it's a $50,000 annual amount. Okay. Okay. Are origination fees, application fees taxable and are they part of form? I don't know the answer to that. About the question is, are origination fees taxable and are they part of Form 1098? I don't know the answer to that one. I'm sorry, I don't. I'd have to look that one up. Sorry, I don't want to lead you astray by guessing. I have completed 4 years of undergrad and 1 year of pharmacy school. I was still only offered 20,500 for this upcoming year. This is consistent among many students I've spoken to throughout various class years in the program. Is this a problem with our institution or somewhere else? So this is the one where someone kind of asked a similar question earlier about the 20,500 they were offered. And I think because you've been in the under, oh no, you completed 1 year of pharmacy school already. So Maggie, if you already borrowed either any kind of federal loan in your first year of pharmacy school, so that would be like the graduate level, it would have to have been the graduate level. So 4 years of undergrad plus 1 year of grad/pharmacy school. Um, You should be a legacy student as long as you borrowed in that first year of pharmacy school, which would essentially be like your fifth year in college, essentially. And where you would be, I think you should be on this on the legacy side here, which is this slide. Um, but I would say if you have a lot of students from your school that are were offered that same amount, that here's why it could be happening. There was a recent court action, a stay, if you will, that was released in July. No, I think it was actually the end of June. And right around the July 1st date, and it forced colleges to do a really like a screeching halt for a minute. And your school may have interpreted um, so let me tell you more about that. Basically, this slide here on the different degrees, there was a court action that happened right around July 1st, but it was right before it. And it basically was like, hey, wait a minute, these could change. These degrees could change off of this list of 11. And so some colleges and universities may have taken a conservative route. In fact, I have heard that they have in my field. I mean, I'm on lots of listservs and I have a huge network of people in financial aid. Sometimes they might have taken a conservative approach just because the court action was still out there. And so they might not have wanted to offer, like you know, more than you might actually end up qualifying for. So I would say that it would be best to probably check with financial aid, see why that is the case. Like, are you really supposed to be a legacy student? And is that why they gave you the lower amount for now until that court action is resolved? Here's the thing, you're right on top of school. So at this point, like I don't know what to do because see what the financial aid office says in terms of advice. Because you're right now you're at the point where you're trying to start classes. So it's been a rough year, let me tell you. Financial aid folks have been through the ringer. So the rules have just been gone wacky, crazy all year, and interpretations of things. So, Maggie, I'm sorry for the long answer, but that's my only hunch is that maybe that's why they did it as a conservative approach on the short term. So, I don't know. But that's my best guess on that. Okay, and then Danielle got the rest. So, I hope that was helpful. I know that it's tough, it's been a kind of a tough year, and as you're looking into school, it's with rules changing, that's no fun, so. But anyway, here's my contact information. Danielle knows how to reach me as well. And if I can help, I'm happy to do my best.
Awesome.
Okay.
Kat, thank you so much. This is what such a great session. Thank you for staying a little bit longer and answering all of those questions.
Sure, of
Um,
course. Yeah.
Like I mentioned at the beginning, we did record this session. It will go to all of the registrants sometime this week, along with the slides. And then after that, we'll also put the recording onto our YouTube, the Pharmacies Right for Me YouTube, so you can access this and come back to any of the information that Kat shared with us today. But join me in thanking our speaker for taking the time, especially in the evening, to share such great information with us. And there will be another similar session that College Ave will be hosting at the Virtual Pharmacy School Fair happening September 10th. And I'll share that in the follow-up email as well. I hope to see you all there. But with that, thank you so much and have a great rest of your evening.
Thank you.